Hello and welcome to Tax Matters. I am Chiamaka Ohaochi. Today on Tax Matters, we are sticking with the story of the Nigerian Tax and Fiscal Law Amendment Bill 2019, otherwise known as the Finance Bill. Recall that last week we devoted the entire episode to the story of the public hearing on the bill held at the Senate. It was actually meant to be a joint sitting of the Senate and the House of Representatives, but at the last minute, the House decided to go solo. The public hearing at the Federal House of Representatives finally held on Monday, the 25th of November 2019, also in Abuja. It was also very well attended. The day after, the Honorable Federal Minister of Finance, Budget and National Planning jetted out to Lagos to further propagate the gospel of the Finance Bill at the PWC Executive Session, where she met with the movers and shakers of the business and finance community. All we need from you is your rapt attention for the next 25 minutes. Enjoy the ride. The public hearing was held at the House of Representatives hearing room within the premises of the National Assembly in Abuja. The Speaker of the House, Honorable Femi Bajabiamila, was represented by Deputy House Leader, Honorable Peter Apatasin. The Federal Minister of Finance was once again asked to present the Finance Bill. Stakeholders responded this way.
Section 5 and 26 introduced 7.5 to 10% withholding tax on dividends paid out of petroleum profit. International oil companies operating in Nigeria are subsidiaries of foreign companies to which they pay dividend out of profit made from operations in Nigeria. As a result, this provision represents another layer of tax on the pre-existing 85% petroleum profit tax. The implication of this repeal is that the effective tax rate borne by investors is increased.
We are happy with the fact that small companies are exempt from CIT now at 0% up to 25 million turnover. And medium-sized companies of up to 100 million will pay 20%. But large companies still have 30%. In addition to this, they have to pay education tax of 2%, making 32%. And when they declare their dividend, even though I know that's the point OPTS was trying to make, we can say that dividend withholding tax is a tax on the shareholder, but effectively, the shareholders are the investor. They will consider all this as part of their effective tax rates. Nigeria is currently one of the top 10 in the world in terms of the highest income tax rate for companies, including large companies. And I'd like to remind the committee that the national tax policy is very clear, that as we increase the indirect tax rates, such as VAT, we should progressively reduce CIT rate. My recommendation is that we should think about reducing the CIT rate for large companies to about 25%.
I'm the Director General, Federation of Construction Industry. We wish to call the attention of the committee to a long-standing problem we have within the construction companies. And this is with regards to the withholding tax that we are being charged. We are currently being charged a withholding tax of 5%, which is highly in excess of what we can normally make. It was formerly 2.5% until December 2016, when it was increased to 5%. We are proposing that the withholding tax be reduced to 2.5%. It has been a challenge for the government to refund. When they look at our books and find that what they've been charged is above what they should charge, to refund has become a problem, and our capital has been tied down with the government.
The Executive Chairman FIRS responded this way.
On an annual basis, we get 25 billion to give as refund. And the minister has agreed in principle that that refund will be given on a monthly basis. So as long as that amount is paid on a monthly basis, these 5 companies concerned will not have any problem in terms of cash flow. Second, the total amount, the highest amount that we have paid in any 1 year is 25 billion. If we even assume that we put a provision of 50 billion, those 5 companies do not have an outstanding of 50 billion. And if you work backwards, and in the non-oil sector, the 50 billion compared to over 2 trillion that we collect, is very insignificant. But also, I'd like to point out we have at least 50 construction companies that are owing taxes. So if we reduce the withholding tax to 2.5, and it's time for them to file their returns, they'll continue to owe government taxes.
On other matters,
then also the issue of the stamp duty, or I call it the user charge on POS, is not a tax. It is what CBN agreed with the operators on the POS system. I agree in principle that you want to spend or transfer 1,000 or buy 5,000 naira fuel and they charge you 50 naira. Personally, I think it's too high. But I think the CBN has to be called. This is not a tax issue. It has to do with the central bank and user charges that they charge their customers. It's a user charge, it's not a tax.
There's a threshold of 10,000 naira. So where the transaction is not up to 10,000 naira, there is no stamp duty to pay.
The Federal Inland Revenue Service (FIRS) calls on all corporate organizations operating in Nigeria to register for the purpose of payment of taxes and obtain a tax identification number (TIN). All registered companies must obtain a tax identification number immediately from the nearest FIRS office. You can also collect and return tax registration forms from the Federal Inland Revenue Service Engagement and Enlightenment Tax Teams (FEET) on compliance checks exercise in your area. A company which is yet to commence business after at least 6 months of incorporation must pay a pre-operational levy of 20,000 naira in the first year and 25,000 naira for subsequent years to obtain its tax clearance certificate (TCC). Note that filing and payment of VAT and withholding tax returns must be done on or before the 21st day of every month. Register for VAT. File all tax returns as and at when due. Be a responsible corporate citizen of Nigeria. It pays to pay your tax. This message is from the Federal Inland Revenue Service.
welcome once again. We are still on the Finance Bill 2019. On Tuesday, the 26th of November 2019, leading accounting, auditing, and tax consulting firm hosted an executive session on the Finance Bill as its contribution to public enlightenment and education on the Finance Bill. In case you still want to know more about the Finance Bill, we'll leave you in the hands of Mr. Taiwo Oyedele, the tax leader in PwC in Nigeria and head of tax policy in PwC Africa.
This bill has 56 different sections. It's amending 7 different tax laws and it's introducing over 80 different changes. Unfortunately, it seems that the conversation generally about the bill has been about the VAT rate. I'm going to speak to some of the major amendments in the finance bill. One, and for me the most important, is the excess dividend tax provision. This provision in the law currently requires that if you pay a dividend and you do not have taxable profit, or your taxable profit is less than the dividend paid, you pay a 30% tax on your dividend. Notwithstanding that the dividend could be coming from retained earnings that had been taxed previously. Imagine a holding company. The operating company would have paid 30% tax, 2% education tax, deduct withholding tax on the dividend, and it flows to the holding company. When they ultimately redistribute that dividend, you hit them with another 30%. Small businesses with turnover of less than 25 million to be exempted from companies' income tax. Currently, if you have an enterprise not registered with CAC, and if you are fully tax compliant, the maximum you could pay will be less than 19% income tax. Should you have the same business in a limited liability company, your tax rate goes up to about 39%. First, you pay company income tax, 30%. You pay education tax, 2%. When you're extracting your profit as the owner of the business, you pay withholding tax, 10% on the balance. Add it all together, it's about 38.8%. Anybody who understands that will not formalize their business. It's just common sense. Good news. With the amendment being proposed now, that rate goes down significantly to 10%. Why? Because your CIT is 0%. I think you might still have to pay education tax, 2%. The bill is silent about that. And then when you pay yourself, the dividend, you pay withholding tax of 10%. So now I expect many of our 40 million MSMEs to be thinking about formalizing their business. If your turnover is between 25 and 100 million, then you pay 20% and not the regular 30%. Commencement and cessation rules have been removed in a way that it does not create double taxation anymore. Minimum tax provision is a provision that currently makes companies pay taxes even when they have no profit or their profit is too little to what we expect them to pay. Some of the factors that we use in calculating that minimum tax include your capital and your assets, such that for companies where it's capital-intensive sectors, even when you haven't started earning revenue, you have to, on an annual basis, calculate income tax based on your assets and capital and pay to government. Essentially, you're paying taxes from your capital. Okay, so this has now been amended to be 0.5% of turnover, no longer on capital or assets. And then we have insurance companies in terms of fiscal equity were being treated adversely compared to the rest of the society. They could not carry forward their losses, they had tax, they could not deduct all their expenses. And we do know that around the world, insurance companies are actually better able to mobilize long-term funds. So if you do anything to promote insurance business, you're promoting the economy. You can now get a bonus, 2% if you're a medium-sized company. Remember, small companies don't pay CIT. And then 1% for large firms if you file your returns on time. Any expense that you incur to earn exempt income, you cannot deduct it. This is currently in the law. This is just to make it clear. Otherwise, it's like a double dip. When you claim exemption for the income, and you take the related expenses and deduct it against other income that are taxable. Dividend distributed from petroleum profit to suffer withholding tax at 10%. It will now attract withholding tax at 10%. Banks are to require for your tax identification number, and then email can be used for your correspondences with tax authorities, and the definition of supply of goods and services for VAT has been expanded. And then we have reverse charge for VAT. And there's the registration threshold for small businesses of 25 million. So if your turnover in a year is less than 25 million, you don't have to register for VAT. Then compensation for loss of employment for those who lose their employment. If you are paid 10 million or less, you don't have to pay any tax. Only when you are paid more than 10 million should you pay taxes. Stamp duty is one area where people have been complaining about POS, 50 naira charges. This bill raises the amount from 1,000 to 10,000. So only when your single transaction is up to 10,000 would you have to pay the 50 naira.
Mrs. Zainab Ahmed, Minister of Finance, Budget and National Planning, was a special guest of honor at the executive session.
The performance of the economy in 2018 reveals that a lot of improvements have been recorded, to the fact that we have now 45% non-oil revenue in comparison to what we have in previous years. Based on the non-oil revenue performance as at June this year, we are on track to improve our tax to GDP ratio. Although we're improving, we're very far away from the average in sub-Saharan Africa, which is currently about 19%. Our neighbor, Ghana, for example, has a revenue to GDP ratio of about 14% by the end of 2018, and we're at 6%. Whereas other African peers, including Cameroon and Kenya, have 16 and 18% respectively. To enhance fiscal sufficiency and also buoyancy for sustainable development, Nigeria needs a lot of resources to actualize its economic growth aspirations. Regarding the 2019 budget, the current year that is running, by half year, the actual aggregate revenue that is as of June 2019, was 2.04 trillion. This is indicating a 42% shortfall of revenues against targets, and we're attributing this underperformance to both the oil as well as the non-oil revenue sectors. Similarly, revenue shortfalls have been experienced in previous years, but in 2017, the shortfall was much higher than what is recorded by half year. So there has been some improvements. The infrastructure master plan, that is an assessment of what we need to bridge the infrastructure gap in our country over the next 30 years, puts the funding requirement at $3 trillion US. And that means that we need an average annual investment of $30 billion US on infrastructure just to bridge the gap. We know that just with government revenue, this gap cannot be bridged, and therefore we have to take measures to improve the business environment so that more businesses will invest in our country and also invest alongside government to bridge the infrastructure deficit. The finance bill has 5 strategic objectives. The first is promoting fiscal equity by mitigating instances of regressive taxation, such as tax reforms for the insurance industry, which has been explained earlier on. Second is reforming domestic tax laws to align with global best practice. And in this area, the example I will give is taxation of digital business as well as e-commerce. Thirdly, introducing tax incentives for investments in infrastructure as well as in capital markets. And the targets for us is to provide incentives for real estate investment opportunities and security lending in the capital market. The fourth objective is supporting micro, small, and medium-sized businesses in line with the ease of doing business reforms. And in this area, what we did is lower company income tax from 30% to 20%. We believe by doing so that small businesses will be encouraged to be formal and to actually grow. The fifth objective is, of course, raising revenues for government to finance its budget. And the example I'll give here is that we have increased the VAT rate from 5% to 7.5%. We've also introduced excise duty on some imported excisable goods. And the essence for us is to bring parity with goods that are similarly manufactured in Nigeria to remove the disadvantage that the local industries are currently facing.
Thereafter followed a panel session.
What is the federal government doing to bring more people in the tax net instead of taxing the people who are in the tax net more?
So we are improving the tax collection processes by using a lot of automation and automation to bring together data on taxpayers from different sources to identify people that are not in the tax net. We also anticipate that some of the incentives we've provided in the finance bill will encourage the informal sector, a good number of participants in the informal sector, to actually come into the tax net and be paying their taxes. The Inland Revenue Service has also taken tax offices closer to the people. They have put in place e-filing, also e-registration to obtain a TIN number and so on. And we are strengthening the coordination process so that wherever a citizen goes to demanding for service, we'll be asking for evidence of registration within the tax net.
Is it fair to say that the message from the government is that the days of a high net worth or high income earner not being part of the tax net are coming to an end in
They
Nigeria?
are coming to an end. We have a robust database now. We pull together data from the banking system, BVN, from the NIBS, from the Inland Revenue, from Customs, from Corporate Affairs Commission, different sources. So we pull them together and we're able to mine those data to identify persons that are not paying their taxes, or even persons that are underpaying taxes.
What are the expectations of the business community from the finance bill?
One of the expectations from government will be to do a form of signaling. And what I mean by that is, in many countries, government will give you an idea of what to expect, even sometimes years ahead, because businesses and investors don't like uncertainties. You know, I think Andrew alluded to this in an event we both attended recently, that there are about $17 trillion of investable fund around the world that is currently attracting 0% return or negative return. So the question is, why would anybody put their money somewhere when they know what they will get back will be less than what they put there? It's because there's certainty. They know they will lose 1%, but it's certain. So they go with it. If we can make Nigeria very attractive, why should we not attract 2 trillion from that 17, given that the returns here are very great? But that would only happen if we get to a point where we start signaling and ensure that the way we approach the system, the business environment, taxation, regulation, is coordinated, one, within the federal government, agencies, arms of government, and subnational with state and local government. I'm not saying this is going to be easy, but we have to make it happen. When people do businesses, if someone is doing their business in Lagos, they're just doing business in Lagos. They don't care whether the regulation or the tax is from local government, or whether it's from state or it's from federal government. Once you ask them to pay tax, they just know Nigeria is asking them to pay tax. And I'm hoping that by the time we're doing the next finance bill, we should be proposing to repeal over 100 different taxes that are low yielding, providing avenue for corruption, and increasing the burden of Nigerians. This is why many times when you ask Nigerians, they say they pay a lot of taxes, but government say we collect so little. They're actually not lying. Is that in between, there's a lot of leakages, inefficiency, and wastage.
As a parting speech from me, what I would want to say on behalf of the private sector is that I think the government should take us as partners. There should be a lot of engagement before policies are formulated. We are not at par or struggling with each other. This is a country where investors have invested in. We want the country to grow. So we should sit together at most times to formulate policies together that we will both see it developing the economy. It's the interest of manufacturers and the private sector for the economy to grow, for the country to grow. So we will definitely not impede any laudable programs that the government will want to do. I would want to plead that stakeholder engagement should be very paramount, and superior arguments will always take the day. Thank you.
And this final one.
When is the effective date of this tax change?
I think the effective date will be once the National Assembly has passed it. It's been passed by the Senate. We had the public hearing at the House of Rep yesterday. Once they pass it, they have to harmonize, and it goes to Mr. President. Once Mr. President assents, then it becomes effective. But I do expect that the actual implementation will be from the 1st of January. It's a New Year day, the 2nd of January 2020. But I'm sure the Honorable Minister can confirm.
I hereby confirm.
Okay.
Now that the two chambers of the National Assembly have listened to all shades of opinion, now that both chambers have passed the finance bill, and all that we are waiting for is the assent by President Muhammadu Buhari, all we can say is that we look forward to a robust business environment in 2020 and beyond. Already, signs are emerging that Nigeria is gradually becoming the destination. You remember the visit of Jack Dorsey of Twitter and that of Jack Ma of Alibaba. Although Alibaba did not come with the 40 tips, maybe they are seeing opportunities that Nigerians can't see. Our advice? Gird your loins and prepare for a vibrant economy in 2020 and beyond. Thank you for watching. See you next week.